guys, it's Hudson Fisk here. Once again, I want to bring my IT guy, Nick Lambert, in on the video with me because there's a bit of a contrast between he and I. He's 26 years old. I'm 56 years old. And we're both investing in the stock market and IRAs and so forth, and 401ks, all, trying to build up a savings for our retirements. And we each have our own separate strategies for trying to, that we're using to get to where we want to be in older age. Of course, I'm hoping to retire a lot sooner than Nick might want to. So, the strategies that we're employing are a bit different. Now, as a younger man, I was always told to put some money into index funds and don't try to become a stock market expert or anything. Just play the market and invest in the S&P 500 and you'll be fine. So that's pretty much what I've done up until about a year ago. Now I still do put money into that as well, but I've gotten a lot more involved since in the past year and started another separate account of my own through Charles Schwab, where I buy and sell individual stocks based on my own research. And Nick, what have you been doing exactly?
So I've actually, about a year and a half ago, I started a Roth IRA account. The reason I chose to do a Roth IRA over a 401k or another retirement strategy was because I'm also self-employed. It just makes sense to put into your retirement after tax so it grows tax-free and you're not taxed when you withdraw from it. So within my Roth IRA, for the most part, I buy mutual funds. I was always kind of told growing up too, index funds were the way to go. The difference between index funds and mutual funds, amongst other things, is that index funds are usually aimed at matching the S&P 500's growth rate on an annual basis, whereas mutual funds are aimed at surpassing that. So I have one mutual fund that I try to purchase once a month as I monthly fund my Roth IRA account. That one has a 10-year running average of 19.1% on its return rate. Now, where people get confused on mutual funds and index funds and all those managed types of trades is that it's really a long-term growth strategy. You're not going to become rich quick off of them unless you have a large sum of money that you can sink into it. So I kind of did a rough calculation. If I stuck with this fund and put $500 a month in it for the next 30 years, which would bring me up to Hudson's age, that account would be worth approximately $9.5 million. Now, if I were to drop that down to a less risky mutual fund, one that earns an average of 12%, which is kind of the common, that's like the safe ground between your amount of risk and your amount of reward. If I did that with the same amount of investment, it would be worth about $1.7 million after 30 years. So as you can see, there's quite a contrast in those ending years and how much compounding interest you grow on your investment. Ideally, I'd like to retire sooner than 30 years, but that's why I've also do a day trading type fund account as well, where I buy funds much like Hudson does and trade options, things like that. I look at that more as kind of icing on the cake, so to speak. So the mutual fund, Roth IRA, is kind of my foundational investment for retirement, and then anything else on top of that will just be potentially a sooner retirement or a more prosperous retirement.
When my wife and I set up our Roth IRAs, she was not as aggressive as I am, so we agreed that I would have the aggressive account and she would take a more conservative account. And overall, I believe my account has performed quite a bit better, but hers has been done well in times that weren't so good as well. So it gives you a little comfort.
Yeah.
Back when the 2008-2009 time period was happening and the market kind of tanked, her account held up quite a bit better than mine.
Yeah.
So there, it's nice to maybe have a little bit in each.
Yeah.
If you're going to do that, if you're going to invest into funds like that, the S&P I think is probably the most popular.
Yeah.
It's anything that tracks S&P 500. You're basically just playing the whole market.
Yeah. Ideally, you always want to diversify your investment in the stock market through different industries and also between domestic and international companies, because that'll kind of help during those periods. Like we had in 08 and 09. Yeah, because you definitely, like, I know the funds that I invest in that are earning that average of 19.1% are very heavy holdings in tech industries with companies such as Tesla, probably Microsoft, Apple, those kind of things, which are, right now, they're growing really rapidly, but they are more susceptible to economic variables that could cause them to experience a rapid decline like we did in 08 and 09. So.
Yeah, and another thing too, and this is probably the topic for a whole nother video, but a lot of these stocks that have been go-to stocks for many years don't necessarily guarantee that they will be always the go-to stock in the future.
Yeah.
And that's something we should probably talk about, because I have some pretty strong feelings about some of the really big names that people invest in.
Yeah.
Aren't going to be the place to put your money so much here in the near future.
Yeah.
And I have several reasons for that, but I don't want to get into that right now. But what I will say is that since I've started buying and selling stocks and options in the market in the past year, I've kind of taken a mixed strategy. I'm generally a pretty aggressive person, not a real patient person, so I try to build, if I want to make money, I want to make it now. But I want to do it as intelligently as I can. I don't want to just be throwing a bunch of crap on the wall and see what sticks, because that's a good way to lose your money. So I do make some educated, I guess you'd say educated guesses, because I'm not by any means, I'm not a professional investor or financial advisor or anything like that. But what I've done is kind of mix a strategy of buying and holding companies that have been around, that are proven, some pay dividends, which is nice, and that long term you're very comfortable with holding, even though they may not be real huge winners every year. They're going to be consistent, building a gain throughout the years. At the same time, I'm buying into SPACs, companies that are up and coming. So I buy into SPACs that I think might have a big future ahead of them. And a lot of times those stocks are only $10 or so to get into if you get in early enough, sometimes less. For example, just the other day I bought BNGO because I really am excited about where technology is going for the health industry and medical industry, and things like CRISPR and Editas, biogenomics. Kathy Wood at ARK Invest talks a lot about these types of stocks as being the next Tesla for 2021 and beyond. And I think she's absolutely right. We really are, our humankind really is on the verge of curing a lot of diseases that have haunted our mankind for many decades, if not centuries. And there's a lot of wealth to be created in investing in the right companies right now. And anyway, long story short, 2 days ago, I bought BNGO. It's just a little penny stock pretty much. I think I bought it at $2.60 that morning. And by the end of the day, it was $4.03. And, I bought 1,000 shares just to play around with it. But that's the kind of gains you can make that are highly speculative. You're throwing Hail Marys when you do those plays. But it's kind of fun.
It's definitely more of a proactive investing strategy as opposed to a reactive one.
Mm-hmm.
I think that's where a lot of people make mistakes in their investment, is they purchase a stock after it's already done that climb, kind of like you described.
Yes.
Because that's when a lot of forums and chat groups catch on to stocks. And at that point, it's just, for the most part, it's usually too late to invest in it.
Exactly right. And that's called fear of missing out, or FOMO investing. Don't do that, guys. If you learn about a stock, the first thing you should do is bring up the chart. And if you see a huge gain in the last few days or week or two, I tend to really shy away from it.
Yeah.
Because the gains are done. But back to the BNGO stock, if that thing tanked tomorrow, I'm comfortable holding that stock long term, because I believe the technology they have is a real game changer for helping humankind. And that's the kind of companies I want to support. Companies like BNGO and CRISPR, Tesla, they're all these types of companies are going to make the world a better place for everyone. So I try to avoid companies that maybe are, not so much, like Philip Morris, smoking stocks, things like that, where it hurts our health. So I don't know if I should say that, but just go by, let your conscience be your guide. You should feel good about the stocks you're holding. That's the key. And let your conscience be your guide, and that'll help a lot for you. Pick the right stocks that will make you successful. Because basically, if it's going to be good for humankind, it's going to be good for your wallet long term. So
I think that was a great point you made, because a lot of people don't think about things like that when they invest, is what am I actually investing in, other than just looking at the direct I'm going to make money off of this, but is the product I'm investing in bettering the world, is it harming the world, or is it not affecting the world at all?
Exactly, I agree. Well guys, I hope that gives you a little food for thought, and please like and subscribe, and even more so give us your comments. We'd love to know what you think, and give us your ideas. We'll touch on those if we see something there we can add to. So appreciate your time, and we'll get you on the next one. God bless.
Bye.